Hello, everyone. Welcome to Accounting Focus, where we talk a lot about the principles of IFRS and focus on solving past standard questions from ICA, ACCA, and Cima. My name is Kolaji, a young chartered accountant, and today's episode is going to focus on another important asset standard called investment property, IAS 40. Now, this standard gives us the definition for investment property. At what point can we show investment property in our books? That's the recognition criteria. It talks about initial and subsequent measurements. If we should buy the asset today, what value should we show in our books? And if the assets, we should use the assets for a time being, how should we account for it, right? Now, it also talks about disposal. If we should dispose the assets, how do we treat it? And then the disclosure requirement also gives the principles on how to disclose, information about investment property. Now, without wasting my time, let's focus on what IAS 40 really talks about. Now, we can't understand IAS 40 without first establishing the definition. So, what is the definition? It is saying that investment property is a property, that is land, building, or its part or both, that is held, 1, to earn rentals, 2, for capital appreciation, or for both. So when it comes to investment property, you realize that from what we've established so far, we are talking about tangible, immovable objects. So we are focusing on immovable objects, tangible, immovable objects. So when it comes to investment property, I want you to think about land, building, or think about any immovable object. Now, you ask yourself, what is the purpose? Why am I holding this asset? If it is to earn rentals or for capital appreciation, it means that it can be classified as investment property. Or how are you monetizing it? So if you should hold an asset and you should give out this asset for rentals, immovable assets, of course, and you should give out this asset to earn for rentals, to earn rental income, then we can say that this can be classified as investment property. Or let's think about land. Now, let's say you buy the land, you are holding the land for capital appreciation. When you say capital appreciation, you hold the asset hoping that in the future, the value will appreciate. Is that not it? Before you even sell it, so that you can earn more. Now, if these are the two purposes for which you are holding the assets, then we see that that particular asset can be classified as investment property. So when you talk about investment property, we are saying that they are tangible, immovable objects that you are holding for two purposes: to earn rentals or for capital appreciation, or for both. Now, what you have to think about is that investment property is not used in the production of goods and services. No. It's not used for administrative purposes, and it's not sold in the ordinary course of business. Because if we should own these assets and we are using it in the production of goods and services, then we can say that these assets can be classified under IAS 16. This will be under IAS 16, and this will be IAS 2, more of inventory. Is that not it? So that is what investment property is about. So now, when you talk about recognition criteria, we are saying that at what point can you show this investment property in your books? We now understand what investment property is about. So how can we show it in our books? At what point can we show it in our books? There must be two conditions. So what are the two conditions? The two conditions says that, one, it must be probable that the future economic benefits associated with the investment property will flow to the entity. So when we talk about this, we are talking about risks and reward. It is almost like the recognition criteria is the same as the recognition criteria under IAS 16 PPE. So when you talk about probability in terms of percentage has to do with more than 50%. So if there is more than 50% chance that when you use this asset, benefit will flow to you, the entity, then we can say that this asset can be classified as investment property. And can we give value to the asset? The cost of the asset can be measured reliably. Can we give us a value to this asset? Is it easy for you to measure this asset? If yes, if these two conditions are met, it means that we can show this asset as investment property in our books. you've recognized, after the asset has met the recognition criteria, that, oh, I can show these assets in my books, okay? If you should acquire these assets now, what value do you have to show in your books for the first time? That is what initial measurement is about. So IAS 40 gives us a guideline. So what is the guideline? It's saying that you should consider the cost of the asset. So the cost of the building or the cost of the land that you acquired, okay? Now it's saying that focus on the purchase price. So the amount you paid to acquire the assets, that is the purchase price. Is that not it? If they give you any form of discount or rebate, subtract it from the purchase price. Now, any form of direct attributable costs, let's say professional fees, consultancy fee, legal fees, stamp duty, all these ones are direct attributable costs. You have to add it to this purchase price to get the total cost that should be shown in your books for the first time. So there is some exceptions. We are saying that, note, do not include startup costs. So any form of cost that you incur at the initial stage, which is not directly associated with you bringing the asset to the condition that management wants it to be, then we cannot include it. We cannot include the startup cost. So let's say during the construction of a building, you realize that there was, due to some delays cost. This is a practical example. Due to some delays cost, you ended up incurring additional cost. Should that additional cost be added to the cost of the assets? No, it cannot be added. Why? Because if that delay shouldn't have been caused, the additional cost wouldn't have been incurred. Are you getting the principle? Now, when you talk about operating losses, now what the standard says is that until the asset is ready for its intended use, any form of operation that you use the asset to engage in, and then it ends up giving you a loss, or any form of losses that you incurred in you operating, using the assets for operation, then that particular operating loss shouldn't be added to the cost of the assets. So let me give you a practical example. Let's say you are constructing a building. You realize that, no, I can use this part of the building to sell, let's say, food to the laborers. Why? Because there is no food vendor there. So you decided that, okay, let me use this part for operation. But when you are using that side for the operation, you ended up incurring some losses. Can you add it to as part of cost of the building? No, you cannot add it as part of the cost of the building. Abnormal waste. Now we are saying that when you talk about abnormal waste, for every construction, for every activity that undergoes, there's an estimate for normal waste. But immediately the waste exceeds that normal waste, then we are saying that this is as a result of inefficiency. So you cannot add it as part of the cost of the asset. So that is what initial measurement is about. That is what initial measurement is about. Now, when you talk about subsequent measurement, there are two. So you are saying that after you've recorded the assets at initial measurement, subsequently, how do you account for it? You have to adopt a model. Okay. Now, these models are two. Just like IAS 16 PPE, where we talk about revaluation and a cost model, these models are also two. So we have fair value model and we have cost model. So we are saying that after you record the asset at initial measurement, what model can you adopt to make sure that in the subsequent period to come, you use that model to account for the value that you have to show in your books? So we are saying that there are two. We have the fair value model and we have the cost model. Let's talk about the cost model. Now, the cost model is the same as what you know under IAS 16, where we said you take the cost of the asset, less accumulated depreciation, less accumulated impairment loss. So if any of these ones exist, you subtract it. But I talk about fair value model, we are saying that it is not the same as revaluation model, and you will know why. So I've spoken about it more in the next chapter. So we are saying that fair value model is not the same as revaluation model. So let's see what makes it different from this fair value model. Now we are saying that if we talk about this fair value model, we are saying that investment property is remeasured to fair value. So this fair value is spoken more under IFRS 13, which we will look at it in a different episode, okay? But what you have to know is that when you talk about fair value, it means that you are giving a new value to the assets in your books, okay? Now you are saying that if you should remeasure the asset, if you should give a new value to the asset, it could result in what we call a gain or loss from the remeasurement. Now, this gain or loss should go into your profit and loss account. So profit and loss account. So if you get a gain, you record it at the credit side of your profit and loss account. If you get a loss, you record it at the debit side of the profit and loss account. Are you getting the picture? Now, this is what makes the fair value model different from the revaluation model. No depreciation is charged. So you realize that under revaluation, we depreciate the revalued amount with the remaining estimated useful life. Is that not it? But no, when you talk about fair value model, we do not calculate depreciation. So when you adopt this model, you don't calculate depreciation. You just have to, let's say in your books, it's, let's say, the value in your book was like, let's say 50,000. If you should remeasure this asset, the cost of the asset, and let's say you give it a new value of 60,000, this gives you the fair value, right? You just have to find the difference between this and this, and then tell whether there is a gain or loss. Then you charge it to your P&L account, and then you reduce the investment property with that amount or increase it with that amount. Are you getting the picture? There is no depreciation calculated. Now we are saying that must revalue the investment property at least at the end of each reporting period. This is another point that makes it different from revaluation. Now, revaluation is done periodically. So when you talk about periodically, I mentioned in our last chapter that when you talk about revaluation, it should be done every 3 or 5 years. So you decide. That is a period. But when you talk about fair value, it should be done annually at the end of every accounting year. You have to fair value their assets. Are you getting the principle? So that is what the fair value model talks about. Now, when you talk about investment property, we are saying that there could be a case where we can transfer the asset to or from investment properties. Let me give you a little breakdown. So if we have an investment property, we can convert this investment property to PPE, which is owner occupied, called owner occupied property. So let's assume, let's say you have a building. Initially, you are giving that building out to earn rental income. You're giving it as rent to earn rental income. But at some point, you realize that no, I need this building. I want to use this building for myself, okay, in the day-to-day activity of my business for administrative purposes, or I want it to help me in the production of goods and services. It means that you are transferring the investment property to PPE. So it's moving from IAS 40 to IAS 16. And it can be vice versa. There could be cases where people are using an asset, or they are using a building or land for their own benefit. I mean, in the day-to-day activities of the business for production of goods or services, and then they are also using it for administrative purposes. Okay. But then they want to give part of that building as rentals to a third party to earn rental income. It means that they're also transferring it from IAS 16 back to IAS 40. So we are saying that at what point can this transfer? Okay, we are saying that it is possible only when there is a change in use. So that is what I've explained. Simple. Now, if let's say we are transferring from IAS 40 to IAS 16, what it means is that initially it was an investment property, right? And we are trying to move it from investment property to owner occupied property. How do we account for it? We are saying that apply IAS 40 up to the date of reclassification, up to the date of transfer or reclassification. So if let's say we are in January 1 to, let's say, December 31st, okay, and then let's say I am revaluing the asset at May, let's say 1st May. What I'm saying is that you have to apply IAS 40 up to the date of what? Transfer. So from January, February, March, April, I'll continue using the asset, or I'll continue accounting for the assets under what? IAS 40. And what is the main purpose for this? Under IAS 40, we did not calculate depreciation. And then we are saying that on the date of reclassification, any fair value is accounted for in accordance to IAS 40. So that date, the first pay that they give us, that is the date that they revalued. So let's say at initial stage, it was the value in our books is 50,000. Okay. Now we are revaluing it to 60,000. Now we are saying that 60,000. Now we are saying that, okay, 60,000. Now we are saying that on that particular date, that fair value that we are getting, we should account for it under IFRS 40. What it means is that we just have to find the difference between the 60,000 and then the 50,000 in our books, and then that amount should be treated as gain or loss in the P&L account. We do not have to treat it as revaluation. Are you getting the picture? Where you see that, okay, that means that we have to calculate depreciation at this date. No. They are saying that subsequently IFRS system would apply. So it is after 1st May. So from 2nd May to December, that is where you will now apply IFRS system from that point, where this 60,000 will now be subjected to depreciation and so on and so forth. Are you getting the picture? So the opposite is true. So that is it. Now, when you talk about derecognition of investment property, we are saying that at what point can you derecognize this asset from your books? At what point can you derecognize it? So you can derecognize it on disposal, when you dispose the asset, or when the asset is permanently withdrawn from use. So either on disposal or permanently withdrawn from use. So you sell the asset to earn some money, or you decide that you are not using the asset again. Now, this will result in what you call a gain or a loss. And this gain or loss will go into the P&L account, right? And then so it will hit your P&L, and it's also hit your investment property, that is your assets in your balance sheet. So this is like a breakdown. This is how simple investment property can be. Now, in the next episode, I'm going to take practical questions and take my time to solve it so that you appreciate these principles very well. So if you like this video, kindly hit on the like button. If you have any question, put it in the comment section. Share it to your friends. If you've not subscribed yet, kindly subscribe. Until then, we call it a day. See you all.